Are there any, I guess, ramifications or implications, whichever word you want to use, for the fact that the U.S. and China, they haven't reached a deal, and they're now looking to extend this, temporary tariff reduction, truce, whatever you want to call it?
Well, it seems overly simplistic, but I think the market is a very good scorecard in this regard, and the market really hasn't reacted very much at all to some of these tariff headlines either this week or even last week. So the fact that the market may be exhausted from the last 3 months of constant headlines in that regard, it just doesn't feel like the market is that stressed out about it today, considering we would like to have these things behind us from a fundamental perspective, but from a technical perspective, it really isn't moving the needle.
All right. Fed meeting coming up later, Fed decision coming up. We're in the meeting right now, and the Jay Powell press conference. Widely expected it's going to be a pause. I think everybody pretty much thinks it's going to be a pause, and Jay Powell's also signaled it's going to be a pause. It's really about his tone. I also want to show you something else. This is from Bespoke. Interesting data point. Out of some of the most recent Fed chairs, Jay Powell has the worst performance on decision day for the markets. Markets pretty much flat compared to some of his peers. With everything that's going on in the markets, hitting an intraday high yesterday and then closing lower, are we just set up for maybe a pullback of some kind? Because we kind of have a sense it's going to be a pause, and there's very little he can say to juice the markets.
Well, what's interesting about this week is the Fed decision is set within a sea of a lot of other data as well. So it's not just the Fed decision, but looking at the Fed by itself, certainly Powell has the interest in tamping down expectations from time to time. A lot of times you'll see the statement having some tone, and then you'll see a little bit of an opposite tone from Powell. Frankly, I don't think the Fed really has an idea of what the next move is. You look at a couple of months ago when they went to this data dependency, at that point there was a lot of worries about tariff impacts on inflation, but at the same time, we had to worry about the employment market as well. Both of those things have been tamped down, but at this point, I really don't think they have that clear of a view of where they're heading.
How should investors look at tariffs? We've been talking about it here on the show. We saw another big materials, chemicals company, BASF, talk about tariffs really impacting their bottom line. But other companies have said, not as much as we thought. How, as an investor, should you view the tariff risk in the market and the fact that we may just be seeing the beginning of the impacts, not the end?
I think, obviously, the tariffs have been a headwind for some companies. We're seeing in the quarterly earnings this week, at least, that the tariffs haven't had the impact that were perhaps feared 3 months ago. So that by itself is good news. Clearly, the tariff deals that we've seen will put pressure going forward, but at the same time, there's other counterbalances as well. We have the fiscal spending package, for example. There's some other parts of the tariff packages that should be stimulative going forward. We have a deregulatory environment. So there's other things that may balance against some of those issues.
All right. Knowing that the Fed decision is coming up later today, what sectors do you see performing the best, at least until the next Fed meeting? It felt like we saw kind of a shift to a defensive trade yesterday. Real estate was actually, or beaten down names, I should say. Real estate was the best performer. Industrials was the worst performer. That's obviously been the best sector year to date. Where are you seeing opportunities right now?
At this point, the defensives they had a good day yesterday, but really the defensives are still on their heels. The cyclicals have actually done quite well in the financials. The expectation built into those is still very modest. We do have the benefit of the declining dollar. So in general, I think the more cyclical, cheaper, more value-focused areas, I think will do the best.
All right, can't let you go without talking about tech. Two huge earnings coming up after the bell. Meta and Microsoft, about 10% of the S&P. How are you viewing the earnings and the potential inflection point we could be seeing in the market?
Well, obviously, tech has been the primary driver of the incremental dollar coming into the market. And until that stops working, obviously, that's the path of least resistance is to see tech higher. When we look out several quarters here, the growth is going to start to moderate at the same time as the rest of the market's going to start to accelerate. That's going to put that risk-reward gap into focus. And I think overall, the tech leadership is going to be less of a factor 12 months from now than it is currently.